Good morning, class, or good evening, depending on when you're logging on to see this. Today's video lecture is going to be on Chapter 7, Financial Management. And there's four parts to this Part 7.1, Your Own Money Cash, 7.2, Your Own Money Savings, 7.3 is Other People's Money, which is credit, 7.4, Other People's Money, An Introduction to Debt. And the reason why I'm showing you this is because I think the outline is a little cleaner and the PowerPoint is a little too summarized, I think. So I'm gonna start introducing the presentations by giving you what the chapters are gonna cover. So you have two sources of money, yourself or someone else. You need to decide when to use money and how to do so as efficiently as possible, maximizing benefit and minimizing cost. Learning objectives. Identify the cash flows and instruments used to manage income deposits and expense payments. Explain the purpose of checkbook balancing. So these are your own money, cash. For deposits, we use check or cash or direct deposit, checking account, cash management, and for withdrawals, check, automatic payment, ATM, and debit cards. A checking account is the primary cash flow management tool for most consumers, providing a way to pay for expenses and store cash until it is needed to do so. Balancing your checkbook reconciles your personal records with the bank's records for your checking account activity. So now I know we might not get too deep into this in this class, but when you deposit money into a checking account, essentially what your bank does is they use that cash in order to create credit for people to borrow. Now there's guarantees and the banks are typically insured by the FDIC, so they have a guarantee that if anything happens, that they can always give you that money back. So it's not like how it used to be way back in the day. So your money is guaranteed when you deposit it up to a certain limit, but then beyond that, it's not, in case there's like a financial catastrophe or something like that. Savings learning objectives. Identify the markets and institutions used for savings. Compare and contrast the instruments used for saving. Analyze a safety strategy in terms of its liquidity and risk. Your own money, savings. So for the savings market, you have the money market, which is short term, and then capital markets, which is long term. And we've heard of money market accounts before. For savings institutions, you have credit unions, which allows member saving and borrowing. Retail banks, consumer saving and borrowing. Commercial banks, which is for business, cash flow management. And then investment banks for business and long-term financing. So a lot of us will be on this side, on the left part, unless you are a bank, then you're looking at commercial bank or investment banks. But for the most part, like I think it's called Tropical Financial Credit Union. You have that as a credit union, which is available to people in Florida, and then you also have the Bank of Americas, the Wells Fargo's, and TD Banks, and all those. So there's a couple things to consider when it comes to savings. There's time commitment, risk, and interest earned. Um, Less time commitment is the checking and savings and your money market funds. MMMF. Checking savings, and you have your money market mutual funds. More time commitment are your certificates of deposits, and that's what we mean when we say CDs. Those stand for certificate of deposits. So now you can get a CD and go to a bank and essentially purchase the CD, and um, it becomes mature after a certain time period, and then you get a bit of interest back. Unfortunately, what happens is with the CDs for people who are in the middle or mid upper income ranges, the interest that the certificates of deposits are paying now in our time between 2008 and 2014 are so low that sometimes it's not even worth it to get a certificate of deposit, because by putting money into a certificate of deposit, if you're putting in like 1,000, which is considered a low amount, you're reducing your leverage, your financial leverage, to use that $1,000 for the rest of the year. So a lot of people might not be able, or might not be willing to make this more commitment over here. With the As far as risk is concerned, checking, savings, and certificates of deposits are always going to be less risks, and then your money market mutual funds are going to be more of a risk, and it's more volatile than just putting it in a savings account. And then we all know that the higher the risk, the higher the possibility of getting money back in most instances. But most important thing is that, um, aside from bank bank related kinds of of accounts that can yield an interest, if you ever hear of something that guarantees you a return, always raise a red flag. I can't tell you enough how many times throughout, my life living in Broward, I've seen a lot of multi-level marketing schemes that guarantee you a return of 18% or 16%, and people fall for it. And I've seen also a lot of churches who have fallen victims to the scheme of the forex market. So they give these people who they feel might be experts in the forex market, and then they disappear. There's a lot, and as a matter of fact, a long time ago, I interviewed in the FBI office in Miami for a job, and the only thing that the Miami FBI office does, for the most part, is work with fraud, because in the South Florida area, that's what we're mostly exposed to, is white collar crime and fraud. So just be on the lookout, protect your money, and just remember that outside of banking institutions, or anything that we know that is concretely guaranteed, there is no guaranteed return. Okay. With As far as interest being earned, you get less interest earned in the checking and savings account. As a matter of fact, the checking account might even take money from you if you don't have direct deposit, or if you don't have a certain amount in the account, $5 a month or something like that. The interest earned on the savings account is also relatively lower than a money market or a certificate of deposit. And you can also go to like the Bank of America websites and see what they're paying. And one important factor to know is whether or not the accounts compound daily or yearly. So, for example, and I know this is going like outside of what this class is about. If you get an account that's interest bearing, and the account is, let's say, 2%, that it pays you 2% back. If it pays you 2% at the end of the year, it's non-compounding, which means that they keep track of the amount of money that you have during that year, and then at the end of the year you get 2% back, right? So you can safely say that if you put in $100, you'll get at least $2 back, right? Okay, which 2% is extremely high, for the savings account nowadays. Now it's like a fraction of a percent. But if there's some accounts that also compound monthly, and compound daily and pay monthly. So instead, what they take is that 2%, and then they give you a daily percentage rate. And if you look at the back of your statements of the credit cards, so a lot of times you'll see a daily percentage, right? So then it calculates like how much you have, and then it rolls it over to the next day, to the next day, to the next day, and then it pays you at the end of the month. So think of it like getting a raise, right? if you get paid $30,000 a year and you get a 3% raise, you're gonna get, a 3% increase for the following year, and then if you get another 3% raise, it's 3% of what you previously had, not of the first year. So that's the idea of compounding, that it goes back to look at what your balance was before, and then it increases it. So that's important to know, just whether or not it compounds daily, if it pays monthly, or if it pays annually. Savings. Your choice of savings instrument should reflect your liquidity needs. In the money market, all instruments are relatively low risk, so return will be determined by opportunity cost. Banks serve to provide the consumer with excess cash, a way of having the cash earn money until the consumer needs it. Banking institutions include retail, commercial, and investment banks. Consumers use retail institutions including savings banks, savings and loan associations, credit unions. Savings instruments include demand deposit accounts, certificate of deposit, and money market mutual fund accounts. And I'm sorry that the PowerPoint on previous slides said MMMF. It should have said money market mutual funds from the beginning. But that's what MMMF stands for. A savings strategy can maximize your earnings from savings. And just to give you like a kind of like a savings strategy that I think is very helpful, I call it scraping, right? So this normally works if you have any money left over. So for example, let's have January, February, and then March. And let's use April and then May, right? Okay. So then every single month we're gonna have bills to pay, right? So then what I think has been extremely helpful is you take the amount of income that you're gonna make per month, and then you subtract the bills that you have to pay, and then when you do that, you're gonna have discretionary income or disposable income. You get the idea. You're gonna have money left over at the end of the month. What I have found very helpful, and also some helpful advice for every person, is to take this discretionary income that you earned, for example, in January, and then scrape it off into your savings account before you get paid again the next month. So then the idea is that you're essentially zeroing out your account before you get paid the next time around. So like let's say if I get paid on Friday, on Thursday night, I'll take everything that's remaining in my checking account and then deposit it into a savings account. So it's kind of like a strategy that keeps you on point. It keeps you disciplined with the amount of money that you have, biweekly or monthly, however it is that you get paid, and it also helps you to not live beyond your means, because if you have discretionary income accumulating January, February, March, the likelihood of you going to a very expensive restaurant and blowing a lot of your savings or a lot of the money that you have left over, on one trip to Aventura Mall or something that you really don't need, is very high if you know you have the money in your account. But if you don't have access to it, you're not going to spend it because you're not going to risk putting your account in overdraft. So that's just one thing that I thought was very helpful, and maybe you'll find it helpful as well. Credit learning objectives. Identify kinds of credit used to finance expenses. Analyze the cost of credit and their relationships to risk and liquidity. Describe the credit rating process and identify its criteria. Identify common features of a credit card. Discuss remedies for credit card trouble. And summarize government's role in protecting lenders and borrowers. Other people's money, credit. Credit derives from the Latin verb credere, which means to believe or trust. It has several meanings as a verb in common usage: to recognize with respect, to acknowledge a contribution, but in finance, it generally means to allow delayed payment. So, other people's money, credit. When you're borrowing, you have credit, finance recurring expenses, and then that's short term. Debt is or finance expenses in the long term. Installment credit one vendor, specific for a specific purchase. Revolving credit is for many vendors, and the bank is used as an intermediary. Installment credit, uh, example, chore is a store charge. The payments are arranged with the vendor. So this is when you go to Target and then you buy a bunch of stuff, and then they're like, "Would you like to save 10% by getting a credit card?" And then you're like, "No," and then you always tell them no, but they ask you anyways. That's what that means. So the payments arranged with the vendor. Then you have revolving credit, charge card. You pay in full every cycle. Credit card carries the balance. Your credit rating and your credit score encompasses two things: your payment history and the length of credit history. The payment history is the amount that you owe and also the new credit. And if you run your credit score or your credit report, your student loans should also be there if you have any student loans or if you will get student loans. But student loans are like their own animal when it comes to credit because they do not work like a credit card. The approval process does not work like a credit card. You're basically guaranteed financial aid by the government up to a limit of $138,500 in your lifetime, undergrad and grad. Unless you're in certain professions, like if you want to become like a doctor, a medical doctor, or something in the medical profession, then the borrowing limit goes up to, I believe the last time I checked, it was $225,000. Now, yes, that's a mortgage, but you also have to consider how much money a physician is going to make in their lifetime, and with a lot of the repayment plans that are taking place right now, it does kind of feel like a baby mortgage in a way because it's something that you're going to pay for a certain amount of time, and there's even programs where if you work for like a certain sector, like the nonprofit sector, after a certain amount of years of repaying, the rest gets forgiven. So I think it's a very interesting thing, and it's a really cool research area that I'm very interested about. Credit card features: the credit limit or how much credit will be extended. You have a grace period. You have purchase guarantees, liability limits, and consumer rewards. Sometimes. I'm not a big fan of like cash back at the gas station because you're borrowing, and the APR or the rate, the cost to borrow on that credit card is going to be superior than the amount of cash back that you're going to get. So it's really in some instances not like you're saving at all. Credit card fees, annual percentage rate (APR). APR increases as the balance increases. The APR increases as the balance gets older. You have a late fee, you have a cash advance fee, balance transfer fee, and then an annual fee. And then you know what? I also want to show you guys about um, an amortization table. So then that's a AT. I'm just gonna make a note for myself so that I can show you guys AT. Okay. And amortization tables are very important, and I'll get to that in a sec. Other people's money, credit. As easy as it is to use credit, it is even easier to get into trouble with it. Because of late fees and compounding interest, if you don't pay your balance in full each month, it very quickly multiplies and becomes more difficult to pay. It doesn't take long for the debt to overwhelm you. When in credit trouble, contact creditors, negotiate terms, credit counseling, debt management consolidation, or you can do personal bankruptcy. If it has to get to that point, everybody in the United States is given that get out of jail free card when it comes to doing bankruptcy, so that's you getting a clean slate, and there's different types of programs that you can do. Um, so whenever you have a credit card and you've had it for more than a year or two or three, you always want to try to call the bank and try to do this, renegotiate the terms, or see what kind of credit offers they have. Sometimes, let's say you get a credit card for 10,000 from Bank of America, and you max it out, and you're paying it a couple years in, you see that sometimes when you go in and you pay, it'll tell you, lower your credit card bills, or open, transfer your balance and get 0% interest for 6 months. That's good because it gives you the opportunity. It gives you the opportunity to to pay off that credit card much faster without having to pay the bank the interest, because as much as they want to give themselves the interest from your card, it's millions of people borrowing. I think the banks want the guarantee that you'll pay them back, period. So if they can get everything that they let you borrow first, that's the priority. And if they get a little bit extra out of interest, then that's even better. But banks take a lot of risk with giving people credit because there's really no guarantee other than the borrower's word that they'll be paying every month. Other people's money credit. Truth in Lending Act, effective 1969, 71, and 82. The purpose was to disclose credit terms and interest rates. Because before that, people didn't know how much the interest rates were. The FCRA, which is the Fair Credit Reporting Act, is effective 1971, and it discloses credit reporting process or credit scoring. Before that, people didn't know. The Fair Credit Billing Act, 1975, procedures for billing disputes, error resolution. Equal Credit Opportunity Act, 1975, 1977, prohibits discrimination and specifies procedures for extending or denying credit. So one thing that if you want to look up on your own time is redlining, RED lining, and that's when they used to determine your credit worthiness depending on the color of your skin, right? And because it was the systematic way of getting people to live in certain neighborhoods. So now that's illegal. They can't do that. Although there are some people who speculate that they do that. Um, then you have the Fair Debt Collection Practices Act of 1978, which are procedures for debt collection. So I know I used to work citing the Fair Debt Collection Practices Act when I had another job in the collection department of a university, and basically, like, there are certain things that someone who owes money is protected from. So one of those things is that they cannot be called by two entities at the same time. Like, for example, let's say you owe money to Broward, and Broward sends your account off to a collection agency which calls you all the time. Since that collection agency is calling you all the time asking you for your money back, Broward College is not allowed to call you as well. So you can only be called by one entity. So it's like things like that try to reduce the amount of stress and perceived harassment that the borrower undergoes. Then we have the Consumer Credit Reporting Reform Act of 97, accountability and credit reporting and scores. Credit is used as a cash management tool or as short-term financing for consumption. Credit may be issued as revolving credit, such as credit cards, installment credit, or personal loans. Credit can be relatively expensive financing. Credit amounts differ by features. In the credit limit, the grace period, purchase guarantees, liability limits, and consumer rewards. Credit accounts charge fees. The annual percentage rate or APR, late fees, balance transfer fees, and cash advance fees. Credit remedies include renegotiation, debt consolidation, debt management, and bankruptcy. Um, and actually, I like how this is here as like the in the order that it is. Renegotiation, debt consolidation, and debt management should go next because that usually charges a fee also, and sometimes it does take a toll on your credit. And then finally, bankruptcy. So I like that order. Modern laws governing the use of credit card and debt try to balance protection of borrowers and lenders. Other people's money, debt learning objectives. Define debt and identify its uses. Explain how default risk and interest rate risk determine the cost of debt. Analyze the appropriate use of debt. Whatever concerns lenders will be included in the cost of debt, and so should also concern borrowers. Lenders face two kinds of risk: default risk, or the risk of not being paid, and interest rate risk, the risk of not being paid enough to outweigh their opportunity costs and make a profit from lending. Your cost of debt will be higher than the lender's cost of risk. Of course, when you lower the lender's risk, you lower your cost of debt. So this is examples of default risk. You have credit score and then you have the 5 C's. Conditions, collateral, character, capacity, and capital. And the book goes a little more deep into that. If you want to read that, well, you should be reading it. But, those are the 5 C's. Then you have interest rate risk, pre-penalty payment, and then a floating rate. So this is the basically the fluctuation of the prime rate from the 60s up until 2013. So then you can see that there was a lot of activity between 1979 and 1982. Then we see the let's see, how far does this go? 2008. After 2008, something interesting happens here, and this is actually the collapse of the right here of the mortgage bubble, the mortgage bubble popping. Let's just call it what it is, and then this right here is basically the boom. That's them overbuilding properties and lending to people on variable rate mortgages. So there's more regulation now in keeping the prime rate flat. So it's just something that's interesting because banks go to the government for what is the acceptable amount or the acceptable rate that they can charge, so that there's no what's called predatory lending. Credit is finance short-term consumptions, more costly. Debt, finance long-term assets, more difficult to be approved. So then debt, this is a car or a house. And then credit, this is for short-term consumption, credit cards, lines of credit for, going to buy things at the mall. Debt is an asset management tool to use to create wealth. Costs of debt are determined by the lender's cost and risk, default risk, and interest rate risk. Default risk is defined by the borrower's ability to repay the interest and principal. Interest rate risk is the risk of a change in interest rates that affects the value of the loan and the borrower's behavior. Debt should be used to purchase assets, not to finance recurring expenses. And that concludes chapter 7, and I promised that I would show you what an amortization table looks like so I can explain it. And I'm just going to find a good one online so you can see it. Okay, I like this one. View image. Okay, I hope you can see that. But this is basically an amortization table, right? Oh, I did print. Sorry. Okay. So basically, when you get a line of credit, or when you get a credit card, or when you get credit to buy a car, or when you buy a house, there's already determined month to month, right? May, June, July, August, September, how much money you're going to pay, and how much of that bill is going to go to interest and how much is going to go to principal. I know that it's happened to you before, where you're paying a credit card, you're paying it, and then you look at the balance and you're like, wait a minute, it's not paying, I'm not paying anything. Well, the reason is because the bank is going to try to pay their financing charges first and their interest, right? So that's what they're going to try to do. So now, for example, this is this is an example of a mortgage of $500,000. The first payment is due May 2009. The interest on this is 5.4%. The term is 30 years. Okay. So now, if you look, in 2009, these red bars are the interest. And then the person pays every month and month and month. And then you see that the green goes a little higher and higher and higher. So now there's a point at which in 2029 the amount of the interest goes down every month and the principal goes up. So now this is a fixed term mortgage, by the way, okay? It's not that 5.4% of every bill of every payment of $2,807 you send gets set aside for their finance charges. They're paying it first, okay? So they're paying themselves first up until 2027, and then you start seeing more principal getting paid. Now, there is a way to trick this, okay? Every time that you make a payment and it says balance due and you remit payment on it, the next day or the following day, it's going to say zero amount due. That's an opportunity to send an extra payment to the bank and tell them for principal. If you do that, then what happens is that the amortization table of the bank gets thrown off. Because if you, like, let's say you have a balance due and you decide, like, oh, I'm going to send extra. So right here it's 2,807. Let's say you get your income tax and you're like, oh, I want to pay double. I want to pay 5,600 instead, so I don't have to pay anything next month. Well, what they do is actually they take their cut for the interest of that month, and then they pay themselves the next month also. Unless you specify that that amount is going to principal, they will not apply it to principal. So that's something that's for you to do. I've done it myself with my own credit cards where I pay the minimum amount due, and then when there's zero balance due, then I submit an extra payment, and my credit card payments do go down every month significantly. And perhaps it's something that you might want to try as well to see if it'll happen, or maybe you contact your bank and let them know, hey, I want to add this to the principal, and then let them do that so that you can cut the amount of money that you're going to be paying your bank, which is essentially the cost of borrowing. This concludes, again, the Chapter 7 lecture. And if you have any questions, please feel free to contact me. I'll be more than happy to assist.